Thanks for listening to The Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner, host here on The Professional Edge for going on near 5 years. We're talking about being paralyzed financially, and before we went to break on that last segment, we were talking about annuities, and there are different types of annuities. One is a fixed annuity, and that is similar to a CD. Basically, you're having a contract with the insurance company, and again, it's based on the claims paying ability of that insurance company, whether you get the principal and the interest underneath that contract. So what you do is you deal with A+ high-rated companies and only with them. And what it is you can have a 3-year, a 5-year, a 7-year, and it's a guaranteed annuity contract, which says if you deposit X dollars with us, we're going to give you an interest rate of X. And that's the agreement. It's a contract between you, the person giving the insurance company the money, and the insurance company to repay you based on that credit. So that is a fixed annuity. It is very similar to a CD. It's not FDIC insured. It's insured by the claims paying ability of that insurance company. So when this earns that interest, it is tax deferred. And at the end of that 5-year period, if you have a 5-year fixed annuity, you receive your principal back and you get the check for the interest that was accrued or earned. So when you withdraw that, then you're going to pay tax on those earnings, not until. So it's one way to defer the recognition of income on down the road. And basically, you can continue to roll that forward, roll it into a new annuity, and therefore you wouldn't pay tax on that interest that accrued during that period in time. So you keep rolling them. So that's one way to defer the recognition of income. So that's all well and good. The other one, which is coming around, is a variable annuity. And again, your investment of that $100,000 is actually invested in the stock market. It's called sub-accounts. So inside there, you're in different vehicles that are equity investments. And yes, the value of that fluctuates when the price of the underlying equity investments fluctuate. So it can go up, go down. So the guarantee, a lot of those on a variable annuity, they say, oh, your principal's guaranteed. Yeah, it's guaranteed when you pass away, not during the course of time being the investor in that variable annuity. So be careful if that's being hawked to you by an insurance agent. And again, if they're pushing these annuities, you got to sort of step back and say, well, does this make financial sense for me on what I'm trying to accomplish? So don't be sold something. What you want to do is understand the consequences of it, pros and cons. So that's a variable annuity. Yes, your principal's guaranteed, but it's normally when you pass away. So if you put $100,000 in, the underlying sub-accounts drop to $70,000. You can't go into the variable annuity company and say, hey, I want my $100,000 back. It doesn't work that way. But if you have the consequence of death, then the insurance company will actually send you a check for that $100,000. So it's a huge consequence to pay in order to get your principal guaranteed. All right, so let's change over and get to the last one. It's called an equity index annuity. It's a fixed annuity. Again, the contract is that your principal is 100% protected, and there are no sub-accounts invested in the underlying stock market. So you say, okay, why is it called an equity index annuity? Well, the insurance company is going to base the amount of credit, or meaning the interest that they're going to credit you, based on a change in an index. Now, when you look at this, again, you got to pull the hood up on your car to see what kind of motor is in here. Well, some of them say that we're going to do a point-to-point system. And what does that mean? Well, whatever the S&P 500 index is on the date in which the contract is issued, we're going to wait 1 year from that anniversary date, see what the S&P 500 index is, and then calculate that percentage change. So that's one way that the insurance company may credit you, is based on the change of the S&P 500 index. Now, there are participation rates. What does that mean? Well, what it says is you can have 100% participation in the S&P 500 index up to a cap. So for example, if we say the cap is 8.5%, and you're a 100% participant in the S&P 500 index. And lo and behold, the S&P 500 index goes up 15%. You got to remember, on an equity index annuity, your principal is not in the stock market. You remove that from risk. So if the S&P 500 index goes up 15%, well, you participate underneath this agreement 100% up to 8.5%. And anything over 8.5% that the S&P 500 index gets, you don't get any of that. But you ring the bell at 8.5%, that gets added to your $100,000. So at the end of this 1 year, you would have $108,500. All right, that's perfect. That's locked in. That's guaranteed now. Again, based on the claims paying ability of that insurance company. So what happens the following year if the S&P 500 index drops by 20%? Well, you don't participate going down, so you lock in your gains, and your principal is 100% protected as well. So at the end of year 2, when the stock market, the S&P 500 index drops by 20%, well, you got a 0% gain, and therefore your account value at the end of year 2 is going to be that $108,500. You don't participate when the market goes down. You only participate when the market goes up. So if that is something, you being paralyzed financially on what to do in this environment, we have the election, we have the Fed, we have the consumer running out of credit lines. We don't know which way to go. So therefore, we're very indecisive, and that is actually making a decision. So if you don't know what to do and you want to evaluate whether this makes sense for a portion of your investment portfolio, do give our office a call at 877-654-9798. That number again, 877-654-9798. And with the advance of technology, we can meet down here at the Cunningham Center. We can meet in Atlanta, or we can have a Zoom call to see exactly what you can do if you are paralyzed financially. And a lot of individuals, for some reason, just have not done nothing, have not recognized any of these capital losses. Unfortunately, that creates a tax asset. They just sit here and look. They're not moving things around. We know that the longer duration bonds have been hit harder than the short duration bonds, and it might be in the bond fund. Do you actually know the duration of your bond fund? Well, we can help you analyze that. And again, to schedule that conference, 877-654-9798. That number again, 877-654-9798. So getting back to this equity indexed annuity, we have 100% of our principal guaranteed, again, based on the claims paying ability of the insurance company. If we're in an S&P 500 index, that's the index that's the barometer for the amount of interest to be credited to your account. And let's say the S&P 500 goes up 5.25%. Well, that participation rate underneath our example is 100%. So you get 100% of that 5.25. That would be added to your account value, and that is locked in. So your principal is protected, and the earnings in which you reach or are credited are also guaranteed to your account. So how does your account fall in value? Well, the only way it falls in value is if you, the owner of that annuity, take the money from that account. So that's one way to participate when the market goes up, not when it goes down, and you get to lock in your gains. That is completely different from a stock or a mutual fund or an ETF. Those gains don't get locked in unless you have a limit order on those or a sale order. So the only way you get to lock in those gains is if you actually sell or dispose of that asset. So again, this is one way to position part of your portfolio to get it out of the way of the market risk. And you just got to evaluate on what makes financial sense for you, the listener here on the Professional Edge. And again, we welcome that call. We welcome the opportunity to sit down and evaluate what you actually have and make sure you're on track to that safe and secure retirement that we continuously talk about. And it's okay to recognize a loss as long as we re-implement those capital assets into something that is going to recover. Or we say, you know what, let's recognize the loss. Let's capture and protect the principal that we have. Let's place it in a guaranteed annuity, a fixed annuity for 5 years, current rate 4.9%. Or we say, you know what, I have faith in the market. I'm going to be okay getting a total of 8.5%. If the market goes up 18%, I only get 8.5%. If you're okay with that agreement, then we would move towards an equity index annuity. And there are different ones of these. And yes, there are surrender charges. There are some as long as 14 years in length. I don't recommend those for our clients. So it starts off with a 14% surrender charge. So if you go in the year one and you want back out, well, you're going to pay a 14% surrender charge. That's too much, too egregious in my opinion. And things will change over 14 years for sure. So what we do is we try and keep a little bit closer to the vest. We have one which has a 5-year period that we've come across. It's a pretty good chassis. It's a named company. And I can't share that name on air because that's not fair to the other companies. But if you want to, sit down and have a very candid conversation, it's a 5-year agreement, full walk away, which means you don't have to go out into payment streams for 3 years or 5 years after this. That's another thing that the insurance companies do is they say, oh, if you want your value at the end of this contract, in order to get that value, you have to take out payout over 3 years, 5 years in order to get that. And here's the catch inside there that we've been exposed to that you as a listener here on the Professional Edge need to be aware of, which a lot of agents don't share with their clients. I don't know why, because you should tell them straight up and let the individual make a wise choice. Well, what they do is they say the only way you get that value is a payout over 5 years. And when we pay that out over 5 years, the value that remains with the insurance company does not earn any interest. I'll repeat that again. So during payout, the balance that sits with the insurance company receives no rate of return. I think that's unfair to the client. So therefore, you need to be aware of what's actually going to transpire. Being a tax attorney, a CPA, and certified financial planner, being a registered investment advisor, we got to look out for the best interests of our client. So therefore, we understand the gotchas inside these contracts. And yes, there are gotchas inside here. So if you're being touted a annuity to protect yourself, be sure to get a second opinion with regard to that. And the way you get that is giving our office a call at 877-654-9798. That number again, 877-654-9798. I appreciate you listening to Professional Edge. My name's Sean Todd, tax attorney, CPA, certified financial planner, host here on the Professional Edge.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Sean Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Sean is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Sean Todd to learn how you can benefit from their multidisciplinary practice where where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach estate management counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798.